All right, for a look at some earnings movers, let's welcome in Diane King-Hall. She joins me at the desk. So Diane, Jenny got the winners beat.
I know.
She covered Spotify and Palantir.
I know.
And you're on the losers team.
I know. I was like, what just happened? But to be fair, PayPal, it actually was difficult to find anything wrong in their earnings because besides beating on the top and bottom line, they did beat on a variety of metrics. So I had to dig deep to find what was actually wrong. So PayPal is under some pressure right now. It did beat earnings at $1.19 a share. That was better than what the street was looking for. It was looking for $1.12. Revenue came in at $8.37 billion versus $8.26 billion. You saw a user increase there. That increased by 1 million. You saw volume increase, total payment volume rather. That climbed 7% to $437.8 billion. That was actually in line with estimates. Now, operating expenses, those were 6.93. That's mixed on views. It beat some expectations, didn't beat some expectations. What could be the problem? Their guidance on free cash flow. That did miss expectations. Their annual free cash flow guide is $6.5 billion. And that was really the only thing that I could find wrong in their report.
Okay, and they're getting punished.
They are.
PayPal shares
majorly.
Down 9.5% right now, officially negative
for the year now. Exactly.
Analysts probably too early to weigh in.
Too early. I was looking for some analyst commentary. Haven't seen them weigh in on this one yet. So I'll continue to kind of weed through and see if there's any changes to analysts' views on this. But so far, again, the only metric that I could find that was a miss was their guidance on free cash flow.
Yeah, it'll be interesting to see what analysts say because I was just taking a look at the breakdown. Basically, 51% hold, 49% buy, median price target $94 a share. So, which implies certainly upside now that shares are down about 9% today. So we'll have to see how that one plays out. Next on your list today is Merck. And
this
Merck
one makes more sense.
Under a lot more pressure. Yeah, and it sounds like Gardasil is a...
Yes, it's to me, it's a push-pull between the new and the old guard in terms of its drug pipeline. We know a lot of times with these drug makers, it's not just about what the current popular drug, but what's taking the place, especially when they go off patent. So we'll go through the headline numbers first. Adjusted EPS came in at $1.72 a share versus $1.69 was the expectation. Revenue $15.62 billion versus $15.56 billion. They did see a decline in sales of their blockbuster vaccine Gardasil, which you were just talking about. That fell 17%. And the other issue is they decided to halt shipments of it to China, and that starts this month in February, and it will go through at least the first half of this year, essentially. So that's a headwind for Merck, because even though they saw growth in Keytruda, its cancer therapy, that is its blockbuster drug, it loses its patent in 2028. So that's one of the challenges, because the idea is Gardasil should replace that. And again, it's all about what is the next drug, what's the next blockbuster drug. And Gardasil had been, especially given that it's for ages 9 to 17, I believe. So it's a wide range there. So they need that, and the street is really beating them up off of that. In terms of their guidance, their revenue guidance did fall short. Their earnings guidance was in line with what expectations are. Full year adjusted earnings are expecting between $8.88 to $9.03 per share for full year.
Yeah, it sounds like the revenue guidance very much impacted by
100%.
Stopping those shipments of Gardasil to China. And as Kevin Hinks was talking about at the top of the show, guidance is always important.
Absolutely.
It seems like given this market, guidance is very important.
It's key. It's key. And, given that it's always important no matter what earnings we're talking about, but in particular for the drug makers, it's important because, again, this is the replacement in theory for Keytruda. So if you're dinging it for 6 months, then how much will that demand come back when, say, they reopen shipments to China? Or how much is that demand filled up in, say, North America?
Okay, so company specific, though, because if you take a look, Pfizer after earnings up more than 1%. Not a huge move, but certainly
no, but Pfizer never really moves much. I mean, it's one that's had difficulty with moving the needle in general ever since Lipitor went away. It hasn't really, besides the COVID boom, and even during the COVID boom, it didn't boom as much as some of the the other players in that sector.
Yeah, and so Pfizer up 1%, Merck down 11% right now. You're also tracking Estee Lauder, which had already had a pretty tough
Difficult
year
time,
and contributing to that today with a 13% decline.
And I mean, Estee Lauder, it feels like it's struggling to find its way in a day and age where you have new products hitting the market and eating up market share from Estee Lauder. I mean, this is a brand that, you know, some young people would probably call their mother's brand, and I kind of cringe inside because there are brands that I use from there, which I am a mom. But adjusted EPS, 62 cents a share. That did beat expectations. Revenue, $4 billion, essentially in line with expectations. But overall, when you look at the bigger picture, besides adjusted EPS, obviously they did post an overall loss for the quarter. They've been working on a restructuring plan. They're expanding that restructuring plan. They're trying to restore some kind of sales growth. They're planning to slash jobs. They're planning to slash anywhere between around 6,000 to 7,000 jobs. And they're expected to book some charges of 1.2 to 1.6 billion. Now, that is expected to be helpful to them, but again, they have had a difficult landscape recently. Part of that was that big bet they made on China, which was good for them for a season, but in general, it's been difficult, you know, for just about any company that plays in China. We haven't seen the growth that we wanted to see there. And so Estee Lauder made essentially too big a bet there. And then they just don't have the popularity. I mean, this is a company, you know, for MAC, for Aveda, Clinique, et cetera, Joe Malone, et cetera. And this now, again, I cringe aside saying it, but they haven't figured out how to make this trendy again. You know, the Bobbi Brown, et cetera. It's competing with e.l.f. now, you know, and e.l.f. has a cheaper price point than a lot of the brands that Estee Lauder has in its house.
Yeah, and it has the Gen Z following as well.
Exactly.
Although we were talking about it earlier this week, e.l.f. has actually gotten pretty crushed over the past year as well. But yeah, I was taking a look, you know, you talked about that weak demand in Asia, specifically calling out China and Korea as weak points and saying that they expect the volatility to continue, forecasting a drop of 10 to 12% in sales for the March quarter. So China, it's very much a weak point there.
It is.
And a lot of competition.
But even here, like, I mean, you know, we pass some of their brands going through, you know, our commute. And when you look at the MAC store, there's hardly anyone in there. That's one of their brands. You know, they need demand. They need to figure out a way to get Gen Z interested.
Yeah, I guess the fact that I wear MAC for work means that I'm one of those.
You better stock up. Well. You're not old, but just stock up.
Diane King Hall, thanks for breaking down those earnings movers for us.